So I have the privilege of doing a brief introduction of a longtime colleague, boss, mentor, Michael Ballo. He joined us at Ascend here recently. I worked with Mike for over a decade, and he's brought a lot of experience to Ascend, working for a lot of big companies in the portfolio management and analytics space. And he's going to introduce our next two presenters.
Good morning. This morning I have the privilege of introducing two speakers. I've been through their presentations and I learned a lot just going through them. I'm excited to hear them present. I think you guys will really enjoy their presentations. First, I have the privilege to introduce Andrew Mills. Dr. Mills is a research scientist in the Markets and Policy Group at Lawrence Berkeley National Laboratory. Andrew conducts research on the integration of variable generation into the electric markets and into the electric power system. Andrew holds a PhD in energy resources from UC Berkeley and a BS in mechanical engineering from the Illinois Institute of Technology. Everyone welcome Andrew Mills, Dr. Mills.
Okay, let's see. So I have quite a bit of stuff to go through this today, so I'm just going to move pretty quickly through this. So this is, I'll be looking at the impacts of variable renewable energy on wholesale power markets. And the way I'll do this is to start by looking at some of the expected impacts that we see from some modeling that we did, looking out at futures with high wind and solar, and then compare that to some historical observed prices to see what sort of trends we're seeing that are showing up from what we expected from the modeling. Then I'll look at the implications of that on the market value of wind and solar, and then some strategies to mitigate what we see as a value decline. This work is somewhat a conglomeration of various different studies that we're doing, and some of them are in different stages of being released. But so there is some chance that some of these results will be further refined and adjusted before we release them. The other thing to note is that this is a big team of us that are working on this at the Lawrence Berkeley National Lab, led by Ryan Weiser. So the first thing, we did some analysis working with a consulting group called LCG, who runs something called the U-Plan model. It's a market simulation model. And they also have a Gen X model that is a capacity expansion model. We created these different futures of high renewable energy and compared that to a sort of a business as usual case where we just extended 2016 levels of wind and solar out to 2030. And we considered this for 4 different regions where we used those 2 models to create sort of a consistent scenario that would make sense given that level of wind and solar penetration. In our high renewable scenarios, we looked at ones that have high wind, where we're up to 30% wind and 10% solar, and then high solar scenarios with 30% solar and 10% wind. And we're going to be looking at what the impacts were to wholesale market prices, and then some of the impacts that has on market value and other decisions. In particular, one of the ones that we're interested in is decisions on the demand side that might adjust based on these changing market dynamics. This slide summarizes the results. It's a bit of an eye chart. And unfortunately, it looks like the formatting changed a little bit. So I'm going to have to kind of highlight some numbers that don't show up here real well. But one of the key things that we saw is that across all of these scenarios, the wholesale power prices did decline on average across the entire year. And that was most significant in the New York ISO region. The other thing we saw, though, is that the more dramatic was the shift in the characteristics of the prices. So the one that's somewhat hidden there is that we have the number of hours that have prices below $5 per megawatt hour. And in our low variable renewable scenarios, that was almost non-existent. But then as we started to go to these higher penetration levels, we saw increasing portions of the year where prices were basically near zero. And in particular, the highest amount goes out to 19% in ERCOT in the high solar scenario. And ERCOT's bounded in, it doesn't have transmission interconnection with its neighbors, and so absorbing that solar energy became challenging, where it was having these very low prices for up to 20% of the year. For the rest of them, the numbers are somewhere in the sort of 5 to 10% of the year range or so. And then the charts down below that show how the characteristics of the diurnal profile of energy prices also changed. And you can see that sort of behavior that's in the duck curve in California also showing up in prices, where on the high solar scenarios, you see a decrease in prices in the middle of the day when you have high solar, and then prices are going back up to their higher levels in the evening after the sun rolls off. And then in particular in ERCOT, we also saw some price spikes that happened there in the early evening. We see quite a bit more variability happens in prices, so we're seeing quite changes to being much more variable for the prices. Then we also saw an increase in the ancillary service prices, and in particular, that was most significant in the regulation down services that we had. So regulation down prices could increase by a factor of 2 to 9, depending on the region and the scenario. And then the other thing was that we saw this shift in the high net load times going from sort of late afternoon around 4 p.m. and pushing out to the evening around 7 p.m. So that was what we saw with our modeling, and then we've now been collecting a lot of wholesale market data to see what sort of impacts we can see from wind and solar at a national level in the US. And so this one chart here shows the frequency of negative prices at all of the pricing nodes across the United States and compares 2013 to 2018. And you can see that there are some regions where you're starting to see increased impacts that we think are related to wind and solar because of the locations of where they're occurring in part. And so we're going to kind of go into those areas in a little bit more detail now and really unpack what the drivers are. So in one of those regions was in SPP, and what we tried to do here was to really kind of understand to what degree those changes in prices and those negative prices are being driven by wind. So one way to think about this chart on the left here is the vertical axis is showing different demand levels, and then on the blue bar, the blue chart is what's happening to average prices during those times. So as average demand levels are changing, you see some changes in average prices, but then on the x-axis is the amount of wind that's occurring at different times. And so you can kind of see that during those low load, high wind times is when you can really see the average locational marginal prices starting to shift downward, somewhat in line with what we were seeing in the modeling. And in particular, those negative prices that we see in that region really occur at those low load, high wind times. So one of the questions we were looking at was, what is generation doing during those times? So this is the aggregate fleet in the SPP region, and we compare what the aggregate output would be during the positive price hours of the year, and then to those negative price hours. And so you can see that wind is generating more during those times of negative prices, whereas some of the dispatchable thermal plants are responding to that, and they're backing down during those negative price times. But there's still quite a bit of coal, for example, that's online during these times, and the nuclear plants are not responding at all, that they're constant throughout the entire year. In California, we did a similar sort of deep dive, and the top charts here just show the change in the net load that's occurred up to 2018 as solar has grown in California. And you can see a commensurate change in the actual energy prices in that area that sort of follow that diurnal pattern. And in particular, in the spring, you can see those low price periods associated with times of low net load periods in the spring. Again, we kind of wanted to do some diagnostics to see if this pricing data could kind of tell us something about the challenges that might exist with meeting those low net load periods. And so we characterized the need for flexibility in terms of that sort of minimum net load level by looking at what the minimum net load would have been with solar and comparing that to without solar. And you can see that in California, as that's been deployed, solar's pushing down those minimum net load levels below levels that would be experienced otherwise. In all the rest of the markets in the US, though, even though there's been some solar deployment, it still really is the sort of nighttime level that sets the minimum net load level. So even though solar's impacting that, it's not pushing down net load levels in other parts of the country. And then on the right hand, we are using these negative prices as a way to sort of tell if the system's having challenges with meeting those low net load periods. And the dark blue bars here show that increasingly the times when you see negative prices are occurring at those same times when the net load is being pushed lower by solar. And so that blue bar, the dark blue bar there is basically times when net load is pushed lower by solar is really the only time that you see negative prices in 2018. We did the same thing with ramping to try to see if there was some sort of way to get a sense of how much solar is increasing the net load ramp rates. And you can see in California that as solar has been deployed, you see a growth in the net load ramp rates that have to be met relative to what would have had to been met without solar. And we looked at this on a 1 hour and 3 hour ramp rate basis. In the rest of the country, you either see ramp rates that are no worse or even actually a little bit better because of solar. So ISO New England, for example, its net load ramp happens in the early morning, and because of solar, you actually don't have to go to as high of a level. So the ramp rate has actually gone down a little bit in ISO New England. So then for kind of thinking about what's a way that we can tell whether the system might be having some challenges with meeting these ramps, we looked for price spikes, thinking that if you had a time where the system was challenged in meeting those ramps, that you would start to have to kick on some of your more expensive but flexible units. So the metric here is the frequency of price spikes defined as 3 times the marginal cost of a CT at any time. And then we look to see, do those price spikes grow as the same time that ramp rates have grown, which you don't really see that. And then we also look to see if those price spikes are occurring at times when solar is making that ramp rate worse. And you can see a little bit in 2017 and 2018 where it's just starting to peek through that there are some price spikes that are occurring when the ramp rates are being made more challenging by solar. But there's not clear evidence yet that this is particularly challenging in CAISO. And kind of going through some of the market documents, it really indicates that the imports are picking up a lot of this ramp need, basically. And so they've been able to manage that so far. One thing that has changed is that the regulation requirements have shifted in California. So in particular, this is showing the regulation down requirements. And you can see that over time, they've started to increase some. And in particular, they're increasing during those times when you have high solar generation. And then commensurate again with that, you see an increase in ancillary service prices during those solar times, in particular for regulation down. And where this comes from is that in order to provide regulation down, you have to have a unit that's online and has some room to move down. So it's got to be selling some of its energy into the market. And if it's doing that at really low prices, it's going to have sort of a higher opportunity cost. It's going to make it so it has to be paid more for ancillary services. So that's where we kind of expect that spike that happens in the spring at low price times that drives up the ancillary service prices. Okay, so now let's jump into what the implications are for some of these price changes on the market value of wind and solar across the US. So let's start on the far right-hand side here. This is showing our estimate of the average market value of all of the wind on a national basis. And what we do is we take the wind generation profile and multiply that by the energy price at that particular node where it would be delivering. And we also do that for capacity prices where we take the capacity credit of wind and multiply it by the capacity prices in those regions. And if you do that for wind at wind nodes, you get a value that's somewhere around $22 a megawatt hour on a national basis. And if we were to instead think about what's just the average price at all generation nodes across the entire US and do that for a flat block of power, that would be on the far left-hand side, and it's closer to $36 a megawatt hour. So the difference between what sort of a flat generation profile would be at all generation nodes and wind can be unpacked into these different components. So first off, wind is not located at the same places where other generation is. It's further away from load, and so that alone decreases the value by that amount going to the first bar. And then not all of that energy is being delivered to load because there's some transmission constraints, and so that's the curtailment component. And then finally, the time when wind is generating isn't necessarily lined up with times of high prices, and that's that profile component there. So you can kind of think about thinking of these different parts as maybe identifying places where you might have a strategy for increasing the value of wind. That national value of wind does vary from region to region. So this is now that same sort of calculation for 2018, but it's doing that from each ISO. And you can see that in ERCOT and SPP, we have much lower values of wind relative to that national average. But then in CAISO and ISO New England, it's higher. One other takeaway from this is just that for wind, the capacity value isn't a huge component to it. It's primarily the energy value of wind. The capacity value makes up at best somewhere around $5 a megawatt hour in recent years. One of the things we wanted to try to do too is understand how this value has changed over time. And a challenge for doing this is just that the market fundamentals shift each year. So natural gas prices move around, capacity prices move around. So to kind of disentangle that changing average price from what we see at the market value of wind, we use this thing called a value factor, and it's sometimes used in the literature. And it's just basically taking the value of wind relative to the value of a flat block of power in that same year and taking that ratio. And so you can see how that's changed over time. And wind in general is somewhere between 60% to 100% of the value of a flat block of power. And those places where it's decreased over time have been places where the wind penetration is increased. So in SPP, for example, we do see this decline over time in the value of wind power relative to the value of a flat block of power. And we've done the same sort of analysis now for solar. And again, you see the same sort of story, that there's quite a bit of variation from region to region and also from year to year. But one thing that does stand out here is that the capacity value of solar can be a pretty large component of the value relative to what we saw for wind. So for, say, New York ISO, it's somewhere on the order of $20 a megawatt hour in 2018, maybe something like 15 in PJM. So in some regions, that capacity value can be quite important relative to what we saw for wind. And then the variation that we see from region to region and year to year is somewhat in line with how average prices change across these different places. So we did that same sort of comparison of the value of solar to the value of just a flat block of power in those locations. And then we look at how that's changing over time as more solar is being added to the system. And you can get this sort of sense, again, in California, is the dark blue dots there, that as solar has been added to the market and you've seen those shifts in timing of when prices are high, that's led to a decrease in the market value of solar relative to just average prices. And so it's gone from a premium of about 140% over the value of a flat block of power to something like 80% of that. And in other regions, there hasn't been that sort of penetration yet, and so you're not moving down that value curve, and they're still staying pretty high. ISO New England, on the other hand, one thing that's interesting there is that it tends to have pretty high prices in the winter, and if solar's not generating as much in the winter, it's not going to have really that value premium as much. And so that's why it's sort of just down at that 100% level. The right thing, though, to compare the value of wind and solar to is its cost. And that's what we've tried to do here in these charts, is on the left-hand side is those lines represent the value of wind power over time in these different markets. And we compare that to our national average of PPA prices that have been signed in the dots there. And you can see that in recent years, the market value of wind is in line with what these PPA prices have been. And in fact, in some places, the value is a little bit higher than the national average of costs. And then in solar in California, even though we've seen this value decline that's occurred over time, at the same time, PPA prices have been coming down, and so the overall sort of market competitiveness of solar has been somewhat maintained over time, even with that value decline. So 2018 doesn't look a whole lot different from an economic competitiveness perspective than 2013 does. That said, there are these sort of looming changes on the horizon of federal tax incentives starting to phase out, and that cost curve will start to shift up perhaps because of the loss of those incentives. And then there might be further value decline with higher penetration levels. So there are some headwinds to think about, and that's what somewhat motivates our last part here, is to think about what are some of these options for maintaining this value and what sort of strategies might be effective. We kind of break this into two different categories. One of them is to think about what sort of changes can you make to the plant itself. So this is what we would call system-friendly wind and solar. And then what sort of changes to the system might you make that would allow it to accommodate more wind and solar into the system? And so we'll go through a couple of these different options and think about how to analyze them. So the first one on wind we can think about is just, does it make sense to site wind somewhere else? So here we're comparing the value of wind at all these different locations where it's been deployed and seeing that there's places where the value is quite a bit higher. And again, that tends to be these places where you have higher energy costs. So as you move up into New York ISO, PJM, ISO New England, you get higher value locations that if you can site wind in those places, it might be higher value. At the same time, you have to think about whether or not the cost is worth it in those regions. Whereas in the Midwest, you can see that that's some of the lowest value in the US. The other thing that's changing over time for the wind technologies is that there's a trend towards taller towers and larger rotors relative to the generator size. And what this tends to do is that you get a higher capacity factor of the wind plants, and you also get somewhat of a broadening of the generation profile from doing that. And so we've looked at sort of comparing the value of this tall tower, large rotor technology to the value of today's turbines. And you can see that there's some places where you could increase the value of wind by somewhere in that $2 to $4 per megawatt hour range by going to this high tall tower and large rotor technology. That also might be actually an opportunity to reduce the LCOE because you do get a higher capacity factor too. So this might be something where there's a real advantage to doing that. And the places where that value is highest is in that Midwest region where you have the steepest decline in the value of wind so far. So places like ERCOT and SPP would have the greatest benefit from moving towards these tall towers and large rotors. We also looked, and this one is one where we've really just skimmed the surface, about what sort of opportunities might there be for wind and solar to provide some of these ancillary services. So if you remember, one of the things that we saw was this increase in ancillary service prices, particularly for regulation down. And for wind and solar that are generating during these times of low prices, there's not much of an opportunity cost to shifting over to providing regulation down instead. And so in this case, we look at just some simple assumptions to say what would be the increase in value for providing regulation down from wind or solar. You can see that there's some places in some scenarios, particularly high solar scenarios, where there could be a boost in value that you could get under these high solar penetration levels by providing ancillary services. The other thing is that we're seeing growing commercial interest in coupling wind and solar plants with storage. So on the left-hand side is data from interconnection queues at the end of 2018. And the lighter area on both of those wind and solar bars are plants that are being added that are coupled with storage. So you can see that there's growing interest, particularly with solar and storage plants, and a little bit with solar and wind. And that we, from PPA prices, are starting to get a sense of what the costs would be for these solar and storage plants from these signed PPAs. So we did some work where we took some of this historical pricing data and then created what we thought might be the dispatch of a storage plant added to a PV. And we compared that PV and storage value to the just solar alone value that we've reported earlier. And there's some optimistic assumptions in here. We're using perfect foresight to dispatch that storage. We're also sizing that storage just to 25% of the nameplate capacity, which is kind of in line with what we've seen from some of the interconnection queues. But by doing that, we can get this value premium for a solar and storage plant of about $15 or so a megawatt hour. And that's pretty consistent across multiple years. And you compare that to some of the PPA prices that indicate that perhaps the cost of doing that is somewhere on the $4 to $10 megawatt hour range. So there is some room there that suggests that there might be a competitive advantage for adding storage at today's costs and value. Then finally, the last two ones here I'll show are just looking at the things that can change in the system that might affect the value of wind and solar. And really where this is most clear is for the addition of transmission to help relieve some of these localized congestion constraints. So the most famous example is the CREZ lines in Texas, where you can see on the left-hand side, prior to the expansion of the transmission system, there was a huge number of hours that had negative prices and a significant amount of wind curtailment in West Texas. After you built out that transmission line, it relieved a lot of that congestion, and ERCOT negative prices disappeared. There's still some up in SPP. And so we can also look at what that's done to the value of wind. And you can see on the right-hand chart that curtailment decreased during those times, and this value factor measure of the value of wind relative to average prices went up right after the transmission lines came online in about 2013. So that's one clear evidence where transmission can increase the value of wind. There's one other place where we've seen that more recently with SPP, that in 2017 there was quite a bit higher number of hours that had negative prices, where it even went up to above 24% of hours at some nodes. And some transmission expansion that happened in the early part of 2018 largely reduced those real severe negative price times. And so we also see that curtailment of wind went down after that transmission expansion. And so the same sort of thing, that you can see a boost in the value of wind after that transmission was added. So again, just to bring it to, it's not just things at the wind and solar plant level, but also on the system level. So I hope that wasn't too fast, but it maybe will spur some interesting discussion afterwards. And please do check out our reports for some of this, and feel free to follow up if you have any other questions. Thanks.
If we have time, we'll have questions later, but now I'd like to introduce Nicholas Steckler. Nicholas leads the Bloomberg's NEF coverage of U.S. power markets. He's based out of New York and was previously research and power systems, system economics at Imperial College London and the National Renewable Energy Laboratory. Welcome.
Thank you. Hi, everyone. Good morning. Put my phone here for time. And clicker is here. So my name is Nick Steckler. I'm here from New York today. It's nice. It's wonderful to be back. I lived here 6 years ago when I worked at NREL as an intern, and it's a great place to be. And it seems like it's been a good conference so far. Just a little bit of quick Bloomberg housekeeping. So this is our group, Bloomberg NEF, formerly Bloomberg New Energy Finance. We're now an acronym, NEF, and that it warrants explaining a bit. Our founder and owner Mike is putting a lot of money into the power sector these days through philanthropies, We're a completely separate division. We're a primary research division within Bloomberg LP. And this is everything we cover these days. So we started out in clean energy, environmental markets, bottom left corner, power, of course, super critical to that piece, and that's the team that I'm on. So I lead our US power research. But we've grown into a lot of other areas. So if you're interested in these other areas, please let us know. But what I'm going to talk about today is power prices, because we have dedicated teams that are looking at the cost of wind and solar and what's going on with natural gas. And I'd say our team spends most of our time looking at power prices and what that means for generation economics of all the different technologies. And then in turn, when that stuff gets built, what does it do to power prices themselves? Very similar to what Andrew just showed. Great presentation, by the way. I think mine's going to be pretty complimentary. And I'll just start out with a slide that I show pretty often. Probably the most important thing to appreciate is that we're in a very competitive power environment. So power prices are half of what they were 10 years ago. That's the first thing to appreciate, is that power prices are very low. But I'll throw a caveat in there and give you this statement. It's that money is clearly moving around intraday. I think it's obvious. So Andrew didn't try to tell you what power prices are going to be 10 years from now. He was actually showing you how power prices are evolving throughout the day. And I think that's true, that resonates. That's one of the things that we're most frequently asked. And probably the most critical example we've seen is CAISO. So this price profile in CAISO, Andrew looked at it through dispatch modeling, through fundamental modeling. I think today I'll give you some useful metrics to kind of do more back of the envelope type calculations, and together I think you'll have a good feeling of what's going on. But let's back up to this idea of power prices being low, because on this other one we'll talk about batteries and stuff like that. But if we talk about why power prices are low, it's because of the low cost of natural gas. And this chart's my favorite. I've been showing it for a while. In fact, it's actually getting quite old. But if you look at this marginal cost of producing power from gas in purple, clearly undercuts the marginal cost of producing power from coal today, right? And so this is kind of the world that we live in now. And I'm saying this is getting old because, we've been in this world since about 2016, 2017. It's been extremely obvious what the gas economics look like. But I want to give you 3 new takes on that chart to take home with you. So one is that this battle between coal and gas is still ongoing. I'd argue we're smack in the middle of a multi-year wave of coal retirements. It's not over yet. So the way that build happens on the grid is so cyclical that we're still going to see quite a lot more of that battle carrying out. What this is showing is just the marginal cost on the x-axis of producing power by every generator in the United States. Remember, gas is purple, black is coal. 10 years ago and now today. So it literally looks like some sort of like medieval invasion of 2 armies. But what I'm arguing is we're in the middle of that. It's going to keep going. That's not really what I want to keep talking about today, though. I want to give you another take. If you're interested in the Mexico market, this story is actually repeating itself in Mexico. So Mexico recently deregulated its power market. There's a lot of gas that's trying to cross the border south into that market. And what I'm showing you here is the basket of fuels that are burned in that market. Starting from the top, some of those are quite expensive. They still burn a lot of oil, not as much coal as the US historically did, but they burn a lot of expensive oil. They import LNG, some of it from the US. And then at the bottom are these natural gas sources that are available just across the border in Texas. And so those are making their way. Our natural gas team says there's quite a few bottlenecks south of the border on the Mexico side, but eventually, as that gets into the market, we'll see probably this same sort of story that I just showed you here. One more take is a really big wild card, and another one that we've been following for a while, and it's around nuclear plants. So this story holds true about baseload retirements. There's a lot of parallels between coal and nuclear getting crushed by low marginal cost of gas power plants. And about 3 years ago, we had to figure out, are these nuclear plants going to close? And we made this chart. So everybody knows this. This is the supply stack in PJM, marginal cost on the y-axis, and ordered by that marginal cost from left to right. So all the stuff at the front has no marginal cost. As you get to the end, you get the expensive burning stuff. We kept it in the same order and then plotted the emissions factor. Same order. It's in economic order. A lot of cheap gas in the front, burning Marcellus shale gas. And then all that coal that doesn't get to run as much as it used to because it's now on the margin. Average load's 100 gigawatts in PJM. And we looked at this. 3 years ago and said, we think that it's very likely that these nuclear plants sitting in the front get bailed out, rescued, I'm indifferent, so you can take whatever language you want, but they will get subsidized to stay online because of the huge carbon emissions that would be incurred if you were to kick them offline and introduce this coal. And so that's actually proven to be true. We needed it for our long-term forecasts on build. It's proven to be true in Connecticut, New Jersey, New York, Illinois. And I'd just say track your local nuke because they're huge and has huge run-on effects for the economics of producing power anywhere in the country. So those are 3 things to kind of twist the low marginal cost and low power price environment. Now let's talk about renewables. Totally different turn. Andrew already discussed this at length, but I'll just define a term, the renewable merit order effect. This is that low marginal cost stuff coming in the front of the supply curve and ultimately dropping prices. This is California, as I said, probably the most important example. The curve without solar, and then you bring in that solar and you kick it over to the one that's colored. Here I want to start showing you some metrics because one of the main things we do is we produce and publish metrics for clients to try to convey a trend. We've been producing LCOEs for over a decade and people have used those to track how costs have come down. Well, so there's some new ones now. One of the big ones to know is realized power price. By technology, if we just plot solar and gas and compare it to the average price per year, what does the actually volume-weighted realized price look like compared to what the average price in the market was? This is the story that Andrew told. Solar went from a premium to the average price now to a negative discount. And this is my favorite because what it shows, this middle chart, is that if we express it in terms of a percentage, this is really easy to remember. As it increased up to 20% penetration, its scalar actually dropped to negative 20% discount to the average price. That's a heavy haircut when somebody tells you that power is trading $30 in the future, ATC, and you just have to shave that down to 80% of that. It's a big haircut that you have to assume on the revenues for that plant. Going forward, just for some background, what drove this historically? Of course, the intersection of reducing, falling renewable costs, the RPS in California. For me, the biggest question here is not necessarily will the economics of solar outpace this, will the cost of solar outpace this revenue decline, but it's more the RPS. Because from our perspective, we've been gearing up a lot of analysis to be able to track this unsubsidized future of renewables as the PTC, the ITC peel off. But I would say that states that set these 100% RPS standards are really throwing a wrench into that and almost guareteeing the price agnostic future of renewables for some time to come. I want to make sure I get to the end and then we can take questions. So that's pretty important. This method is not only useful for looking at renewables, actually. If you're interested in New England, so there's a big transmission line that's looking to bring hydropower from the north, from Quebec. You can use some back-of-the-envelope calculations to try to impact what power price changes might look like by adding that against zero marginal cost production into the market. And so one way is to do it with a dispatch model. For this case, they're actually out modeling that and presenting it to the regulators in Maine. Another way to do it is to use a simple tool like this and look at what's the marginal heat rate in the market, the efficiency of the plant on the margin, and then what's the net load. And so falling down this curve as you add a gigawatt of hydropower indicates that maybe prices in Maine would fall by about $2 a megawatt hour if that gets built. And so we're tracking that. But again, just some metrics for following these things. I think one thing a lot of people are really curious about is ERCOT. Because if we go all the way back to our California slide, as Andrew also said, ERCOT sits where California used to sit, right? Solar achieves a very impressive premium to ATC in this scalar metric. Actually, the coincidence of solar and price profiles and also demand profiles is probably one of the best places in the entire country. And if we look at a summer like what we just had in Texas, billions of dollars being paid out in real-time and day-ahead markets, you really want to wonder what could solar do to these types of peaks. Could solar come in and just lop off these peaks where we know that would have a lot of money paid out to solar and ultimately we know that a lot of generators make an outsized proportion of their revenues during these hours. There's already a lot of wind, so we should maybe start with wind and say, how has wind performed during those hours? This is every single day this summer, wind production in the Texas market. These are the peak demand hours, highlighted in red. So this is when those prices really shot up. And the median generation from wind is actually really quite low. And I think a lot of people know that, and if you look at ERCOT's planning documents, there's a pretty sharp discount on all the wind capacity when they're doing peak demand planning. But now let me show that same wind versus, sorry, these are years on the bottom up to today. Let me show it versus solar and actually specifically coastal wind. So solar and coastal wind, what this is saying, this capacity factor chart, means that they're very likely to show up during those hours. And actually, solar is almost 80% likely to show up during those hours. You can argue a lot about this, whether it has tracking, whether it's in West Texas, whatever, but this is saying that solar is poised to come in and ultimately stunt some of those price spikes. Okay, batteries. So savior or sideshow is the subtitle here. Batteries, we know, do a ton of things. They're like Ferraris of the power system. They can play in many markets, and optimizing them is a big challenge and ultimately a lot of complexity to dig through. But the story that we're talking about in most of these cases, actually in the California case, is moving bulk solar power from the middle of the day to the evening. There's an energy play. But what are they doing today? A lot of them are actually in ancillary service markets, providing regulation. I'd argue that's ultimately a pretty thin market. Let's actually dig into this idea of moving energy from the daytime to the evening. And one way I want to do that is with a metric, which we'll call a per cycle break even. On the left is costs. So our energy storage team tracks the cost of battery storage through an energy storage survey to all of our clients. And it's projected to come down. It's been coming down. And it's colored by component here. In this middle chart, we convert that cost piece into a dollars per megawatt hour figure that you need to earn every day with one cycle of buying a bunch of cheap power and then selling it at the highest price in the evening. It's simple. We could argue about it all day long. We can argue about these assumptions here in gray about how many cycles a battery can do. You know, maybe it does 2 cycles in a day, this kind of stuff. What's the discount rate? But the benchmark I'll point to here, $100. But $100 per megawatt hour is what it looks like you need to be able to capture in terms of spread if you just did this simple operation every single day. So we can go back to our prices and start looking for $100 spreads. Let's look at these markets. This is the day-ahead market on the left for 3 different benchmarks. And then this is the spread, right? So we have to do one piece of math to get from price to spread on the right. We subtract the highest priced hour from the lowest priced hour. And what do those spreads look like? In the day-ahead market, they're actually creeping up in recent years, but they're not $100. No, in the day-ahead market, they're not. In the real-time market, they are. So California's real-time spreads are actually well over $100. ERCOTs are creeping up to $100. There's plenty of caveats here about whether one can even do this. I know Ascend has a model to try to optimize this type of stuff. And it's not easy. You need to be a good forecaster to do this. But if you can capture this, by this metric, just playing the energy market looks in the money, looking at the costs that we have today for batteries. Probably the biggest caveat of all, a lot of the solar plus storage that we've seen built, or let's say storage attached to solar that's been built, has actually been in regulated markets. And the way that that's actually getting paid is not through this sort of merchant, let's look at the power price and follow it dynamic. It's a little bit more through contracting. And the consensus that I want to share with you that we've seen so far, and we're continuing to track it, is that there's really no consensus on how these plants have been paid so far. So these are some of the things we've seen. Hawaii is one example where we see this kind of dispatchable PPA. Looks a little bit more like a tolling agreement for a gas plant. And unbundled, this top right corner is also pretty common. Pay the energy piece, pay the capacity piece. I think this is a kind of a watch this space going forward. And it's just kind of just a totally different world of paying for solar plus storage. Is there anybody that has a question on my stuff or Andrew's stuff, actually, for that matter? Because he didn't get a chance to take any. Yeah, right here in the front.
You had the value of solar on the prior slides, and I think it was compared to the ATC.
Yeah, exactly.
I'd just be curious on how worse it looks taking the daylight hours where wholesale prices are even lower these days, like in CAISO.
You mean do a scalar versus the on-peak daytime?
Just daylight, daytime wholesale prices as opposed to around the clock. It might even look lower.
It'll converge more with the on-peak prices. Yeah, I'm not sure if the scalar would, it'll look more similar to those on-peak daytime prices, yeah. Yeah.
I have a question for either one of you guys, but I'm Andy Husto from Idaho Power. And one of the things we're seeing, and maybe you guys can touch on, is how renewables are affecting the term and balance of month markets. So, one of the things we saw like this winter into the summer is August term prices were trading very high, like $80 2 summers ago. Mid-C and PV were settling on the day at like $300-400. So there seems to be some pressure in the term markets, the balance of month markets, and then it's affecting the day-ahead markets into the real-time markets now that ICE is coming out with like a super peak product so that you can shave off some of those lows where solar's not there. And I'm wondering if you're seeing any correlation between renewables, those term markets, and possibly people trying to secure transmission to accommodate that, which seems to be putting an upward pressure, especially in the summer months, on wholesale market prices.
It's a great question. Off the top of my head, I don't really have a neat answer for you. We can take it offline if you want. Andrew?
Same thing for us. So we haven't looked at that. Those are great questions and things to be looking at. Yeah. One thing we will be looking at some is just trying to get a sense of. I think we're going to start looking into SPP and trying to look at some of the financial transmission rights for some of those places near wind locations. So that's something we haven't looked at yet, but that's maybe where we're going to start looking at some of that. So, but have no other thoughts on your questions.
A question for Andrew. Which of the markets, if any, do you think is a useful reference to think about the Pacific Northwest?
I mean, one thing is that the Pacific Northwest is pretty tied into California, right? So some of those things that are happening in California, you can start to see in negative prices and things like that happening in other places in the rest of the West because of the energy imbalance market. So I feel like because California has a large amount of the load in the West and it's electrically connected, it is somewhat of a signal as to what might spill out in other regions. Other than that, I think the only other one I would think about would maybe be ISO New England, just because I know it does have a lot of hydro capacity that's coming in and sort of can be affecting it, and it does tend to have winter peaks, like I know is common in the Pacific Northwest. But it also has a lot of constraints on the natural gas system that drive prices in that area that might not be specific to the Northwest.
Quick question for Andrew. In your analysis, when you were looking at the solar, were you looking at the curtailment of solar as an option or not?
So in the forward-looking analysis, we did have the ability to curtail solar, and that would occur basically if the energy prices went down below zero. So we sort of were looking at a 2030 case and saying, that if prices are going down below zero, you can curtail solar. So that actually mitigated some of the impacts you might find otherwise. And I think the amount of curtailment that we saw, again, was higher in ERCOT, where you didn't have sort of a transmission interconnection. But they weren't significant. The amounts of curtailment that came out of the modeling, even at that sort of 30% case, if I remember correctly, it was somewhere south of 10% of the energy being curtailed. And then in our historical analysis, we've looked at what curtailments occurred in California and ERCOT so far, those two report. And the amount of curtailment in California, I think for solar, is on the order of like 1% to 2% per year. What was really surprising is that curtailment was actually quite significant in ERCOT, and that was because there's some solar plants that are in far west Texas that are sort of locked in by some transmission. And so curtailment in 2018 was somewhere around 9% of the solar fleet.
All right. Well, thank you very much, gentlemen. This is excellent.
Thanks.
Can we get a round of applause for both of them? Maybe a double round of applause would be good.
Yeah, I like these too.
Excellent. Great presentations.